Minutes after the SpaceX listing went live on the NASDAQ, absolute executive panic ripped through the upper echelons of Wall Street. Early backers, the ones who thought they were holding the winning lottery ticket, so they thought, suddenly realized their $3 trillion golden goose was mathematically engineered to implode. We're sitting on the razor-thin edge of a violent macroeconomic liquidation. The foundational artificial intelligence sector is being turned into a complete corporate meat grinder, and it is entirely fueled by an arrogant, narcissistic delusion that raw capital can somehow override the physical laws of the terrestrial economy, as they call it. SpaceX is trapped. The math simply does not work, forcing us to confront a fatal contradiction. How does a company burning billions on heavy rocket hardware convince the world it is an asset-tight software monopoly before the entire illusion evaporates into thin air? Look, if you're still buying into the mainstream media narrative that Elon Musk is playing multi-dimensional chess with his recent acquisition, you need to wake up right now. You've got talking heads on CNBC every day babbling about SpaceX's integration of XAI, painting it as a glorious multi-billion-dollar battle for technological supremacy against OpenAI and Anthropic. But do you want to know the cold-blooded reality? Do you want to know what is actually happening behind the scenes? The foundational large language model layer, the very core infrastructure SpaceX just bet its entire post-IPO valuation on, is being systematically executed. It is undergoing a violent, irreversible economic restructuring. SpaceX stepped into an open source meat grinder, intentionally engineered to starve, suffocate, and completely destroy every single pure play AI infrastructure firm on the planet. While mega-cap hyperscalers like Meta use their hyper-insulated global digital advertising duopolies to open-source foundational models and crush AI inference pricing into a worthless commodity, standalone AI initiatives are being burnt alive. The market is being aggressively undercut, with closed-source leaders being forced to slash their baseline models, like OpenAI's newly released GPT 5.6 Luna, crashing pricing floors down to a dirt-cheap $1 per million tokens just to survive the open-source onslaught. The tech titans don't need direct AI profits, they just need a guarantee no rival monopoly can emerge to extract crippling rents from their core products. So what happens to SpaceX? What happens to a space conglomerate foolishly relying on a fabricated AI narrative and razor-thin API profit margins to fund its next $10 billion training run? They're going to be systematically bled dry. It's basic math. What we are witnessing right now is a public spectacle of absolute corporate panic. Following its recent initial public offering, SpaceX frantically attempted to pivot its equity narrative away from capital-intensive aerospace engineering and satellite connectivity to desperately trying to rebrand themselves as an artificial intelligence conglomerate just to keep their inflating valuation bubble from bursting. So then, let's take a look at how this train wreck debuted on the public markets. SpaceX listed on the NASDAQ and successfully raised roughly $86 billion. Retail investors, completely blinded by Musk's fading reality distortion field, rushed straight to the trap and fell in. The stock price violently surged and pushed the conglomerate's market capitalization towards the $3 trillion threshold, briefly leapfrogging Amazon and making Musk a paper trillionaire. Whoa. But that peak pricing was entirely artificial. It was the frantic result of an engineered low-float liquidity squeeze, not real, fundamental market value discovery. SpaceX floated less than 5% of its total share capital to the public during the IPO. Freely tradable shares were essentially non-existent. It was a deliberate mathematical chokehold on supply. Then the game got dirtier. The company was fast-tracked for inclusion in the major indices. Massive passive income funds were legally forced to indiscriminately buy shares from this mathematically starved tiny float. The peak valuation wasn't driven by stellar earnings, it was driven by algorithmic crowding and market hysteria. To justify this insanity, SpaceX had to make a massive deliberate pivot into AI, absorbing XAI in a staggering internal merger and immediately dropping another $60 billion in an all-stock transaction to acquire the AI coding startup Cursor. Cursor had popularized vibe coding, allowing developers to write software using natural language. That sure as hell is going great, but make no mistake, acquiring Cursor was a highly defensive, reactionary panic move to plug the technological gaps. OpenAI just dropped its massive GPT 5.6 model family, and its flagship coding workhorse 5.6 Sol is completely slaughtering xAI's native Grok models, hitting a dominant 80 on the Artificial Analysis Coding Agent Index. SpaceX needed to plug the technological bleeding immediately. By integrating Cursor and hooking it up to the massive 200,000 NVIDIA GPU Colossus supercomputer in Memphis, SpaceX is praying that they can manufacture a credible AI narrative to satisfy Wall Street. Now, if you peer past the smoke and mirrors, you run straight into a severe, irreconcilable valuation disconnect. At a $3 trillion market cap, SpaceX is trading at roughly a 94x multiple of its consolidated revenue. Let's be incredibly clear about where that revenue actually comes from. The AI and space launch divisions are actively bleeding billions in operating losses. The only thing keeping the lights on is Starlink's connectivity revenue. SpaceX's core operations are fundamentally capital-intensive, hardware-bound nightmares. To put this utter absurdity into perspective, look at the adult subscription platform OnlyFans. In recent years, they generated billions in gross revenue, translating to massive pre-tax profits, driven entirely by millions of creators with virtually zero physical infrastructure. A few server racks, an AWS bill, and digital uploads. Their margins are pristine. It is the ultimate asset-light cash machine. Look at Starlink. Sure, it generates billions in revenue, but to do that, SpaceX has to physically manufacture thousands of multi-million-dollar physical satellites, strap them into highly combustible rockets, blast them through Earth's atmosphere, and constantly replace them as their orbits decay in the thermosphere. It's a grueling, relentless heavy manufacturing operation. Valuing a low Earth orbit telecom company at nearly 100 times revenue requires a complete suspension of reality. The OnlyFans model works because digital bits are cheap. The SpaceX model is terrifying because physical atoms are incredibly expensive. Now, the prevailing bullish thesis for SpaceX heavily relies on the delusional assumption that the company possesses an impenetrable physical moat in low Earth orbit. The fanboys claim SpaceX has a perpetual, unassailable monopoly on space-based internet connectivity. But a rigorous analysis of global aerospace development shows that this famous moat is rapidly collapsing. The wolves are at the door. Internationally, China is rapidly scaling its sovereign space infrastructure to directly challenge the United States' orbital supremacy, demonstrating massive industrial capacity by capturing over a quarter of all rocket launches. They are aggressively accelerating the deployment of their own satellite internet constellations, engineered specifically to steal Starlink's global market share, while officially formalizing strategies to bypass Western orbit networks entirely. Now, domestically, the physical space moat is being systematically dismantled by Amazon's Project Leo. This is not just another standard corporate rivalry, this is a multi-billion-dollar blood feud. Jeff Bezos is actively funding a mercenary operation, specifically engineered to deconstruct Musk's empire piece by piece. Bezos doesn't care about short-term profit margins right now. He's a predator hunting for market share. To bypass SpaceX's launch monopoly, Amazon orchestrated the largest commercial launch procurement in aerospace history. They essentially bought up every heavy-lift rocket on the planet, securing over 80 contracted launches across 5 rival aerospace providers. It was a complete orbital embargo. Amazon locked up the entire launch manifest just to ensure Musk couldn't breathe. Mainstream media likes to claim Amazon is years behind. Let's look at the facts then. As of July 2026, the retail giant has already deployed over 270 production satellites into orbit across 12 successful missions, officially establishing the third largest constellation in the sky. Amazon is moving with unprecedented aggression to meet its regulatory mandate of deploying 1,618 satellites, representing 50% of its Generation 1 network, by the end of December 2026. Because of this strategic panic pivot to acquire xAI, just to prop up a flagging valuation, SpaceX is now caught in a perilous no man's land. They're simultaneously losing their physical dominance in orbit to heavily capitalized rivals while attempting to fight a terrestrial AI compute war where they are drastically outspent and outpriced by hyperscalers like Microsoft, Google, and Meta, who all have tangible, established revenue. An enterprise cannot be the dominant space company and the dominant artificial intelligence company simultaneously. it is impossible. Both sectors require hundreds of billions of dollars in exclusive, non-transferable capital expenditures. SpaceX is trying to conquer two universes at the same time, while running completely out of fuel in both. Zooming out, the foundational premise justifying these massive capital allocations, the myth of insatiable demand for AI compute, is just being exposed as a collective delusion. The financial elite, insulated in their hyper-sanitized Silicon Valley compounds, genuinely believe that software can override physical reality. They think you can just type a prompt into a large language model and a fully operational data center magically sprouts from the earth. They are entirely detached from the dirt, steel, and the sweat of the terrestrial economy we all deal with every day. Newsflash, bucko, foundational industries face acute physical, demographic, and bureaucratic bottlenecks that fundamentally cannot be resolved by an advanced natural language processor. Look at the construction sector tasked with physically building the sprawling, power-hungry data centers that house all this AI compute. It is facing a catastrophic demographic collapse due to millions of people leaving the trades, and also the fact that no one my age wants to go into the trades to begin with, due to blatant corruption and incompetence. And that's not even mentioning the working conditions, which are just brutal. The youth interest in entering the trades hovers around a pathetic 6%. Large language models cannot wire high voltage substations. They cannot pour massive concrete foundations. They cannot physically lay subterranean fiber optic cables through frozen bedrock. AI infrastructure requires millions of tons of raw material and thousands of blue-collar workers who actually know what the fuck they're doing to build something in the real world. Furthermore, AI infrastructure expansion is running straight into hard political, environmental, and thermodynamic limits, from massive moratoriums on new data center developments in New York to regional electric grids on the verge of total collapse. The frontier of AI development is no longer defined by algorithmic breakthroughs, it's defined by local zoning boards, fierce land use fights, and insurmountable grid capacity limits. The physical world simply lacks the energy, the human labor force, and the political will to support the trillions of dollars currently being poured into AI. And that brings into question the inevitable collision between the myth of insatiable software demand and the hard constraints of the physical world, which has triggered a massive terrestrial overcapacity crisis. Corporate players are hoarding excess GPU capacity under the flawed assumption that enterprise clients will willingly absorb exponential cost increases to utilize agentic AI models. That assumption is actively failing. Corporate chief financial officers are rebelling. They're aggressively scrutinizing technology budgets and pushing back against the economically ruinous practice of unbound AI token consumption. Look at the real-world data. When massive enterprises like Uber deploy top-tier AI agents to their engineers, the budgets vaporize instantly. In recent beta tests, corporations have burned through entire annual AI budgets in a matter of months. That's not even mentioning the one company that somehow spent $500 million on AI. When agentic AI systems loop through a task autonomously, the output token count completely explodes, destroying project economics. At present, human labor is frequently cheaper than agentic compute at scale. A mid-level software engineer provides predictable output for a predictable salary. The equivalent budget spent on premium AI tokens yields a rapidly diminishing return. If token costs contract by 90% for enterprise adoption to actually scale, the revenue model of infrastructure firms that purchase peak market NVIDIA GPUs will collapse, stranding billions in terrestrial data center assets. Same thing goes for non-terrestrial AI data centers. I'm not even going to bother explaining why subjecting highly sensitive GPUs to extreme thermal cycling, intense launch vibrations, and cosmic radiation that randomly flips bits of data, all while making zero financial sense in the process, when there's already a looming glut of cheap terrestrial compute. Essentially, I'm saying you either have to have brain damage, be very stupid, or, have drug-induced psychosis for launching fucking data centers into space when we have a state called Montana to make any fucking sense. I don't fucking know at this point. And yeah, speaking of Musk, the stubborn pursuit of these fantasies has placed SpaceX under severe and immediate financial strain. Despite raising a record $86 billion in its IPO, SpaceX was forced to aggressively tap the debt markets just 10 days after going public. Woo! They immediately took on $25 billion of debt at near-junk interest rates, some locked in for 30 years at a crushing 6.6% yield. The sheer velocity of moving from the largest equity raise in history straight to a massive debt issuance completely alarmed the credit markets, exposing the bleeding underlying reality. Bond yields widened and the cost to insure against a SpaceX default surged. This debt load proves that the capital required to sustain Musk's AI compute is far outstripping the company's operational cash flow and the newly raised equity. The cracks in the armor are widening into chasms. All while the structural weakness in SpaceX's valuation and the broader fragility of the AI infrastructure market are about to be tested by an immediate, brutal catalyst: the impending expiration of IPO lockup agreements. The clock is ticking, and for those holding short positions, the sound is exquisite. When SpaceX went public, it manufactured that low-float environment by locking up approximately 95% of its shares. But to appease early investors, SpaceX structured a highly unusual, tiered rolling lockup schedule. Starting in August 2026, a new massive block of shares unlocks every 15 days, systematically dumping roughly $123 billion of trapped insider equity onto the open market by December. Employees, engineers, and pre-IPO venture capitalists who have had their wealth trapped in liquid stock for years are inevitably going to scramble to liquidate massive portions of their holdings to cover real estate purchases and deferred tax liabilities. As this absolute tidal wave of supply meets an equity market that is already retreating from astronomical tech valuations, the price of the stock is going to be crushed beneath the weight of the new float. The exit door is tiny, and everyone is about to run for it at the exact same time. When the massive valuations of high-flying AI and space conglomerates crashes back to the fundamental realities, the economic fallout will not be just neatly contained to Wall Street. Private equity vultures are waiting in the wings right now to execute massive leveraged buyouts on distressed, overexpanded infrastructure companies, stripping their valuable physical real estate and leaving the operating entities to suffocate under insurmountable debt. But the real tragedy, the actual human cost for this multi-trillion-dollar delusion, will be borne by the working class. This impending pop will violently devastate the real-world industries that were tricked into building these useless data centers. Local heavy civil estimators, site workers, project managers, and public works contractors completely scaled up their operations based on these massive tech promises. They took out brutal commercial loans to purchase fleets of excavators and heavy machinery. They hired specialist labor at a premium. They bet their entire family businesses on the promise of multi-billion-dollar AI data centers. The local economy is completely tethered to the delusion that these AI facilities will actually be commissioned, powered, and maintained. But when the over-leveraged tech giants inevitably default on these build-out commitments, the Silicon Valley architects will be completely fine. They will declare a strategic pivot, they'll lay off their remote software teams, and they will retreat to their luxury compounds. But as for the local contractors, the guys who actually poured the concrete, well, the physical contagion will spread rapidly from corporate balance sheets straight to their job sites. Development projects will be abruptly halted mid-construction. Massive steel orders will be canceled. Trucking logistics networks will experience sudden, catastrophic cargo vacuums. Heavy construction firms will face severe, widespread bankruptcies. The collapse of the AI infrastructure glut will effectively gut the blue-collar industries that relied on the false promise of the artificial intelligence revolution. It will leave behind scarred landscapes of stranded assets, rusting steel skeletons, and crippled local economies. The Silicon Valley elites engineered the greatest tech bubble in human history, weaponizing global liquidity to fund impossible orbital data centers and incinerate cash. And when it completely burns down to the ground, they'll just quietly slip away and look for their next multi-trillion-dollar grift, which is exactly why you should click and watch this video right now, where I break down exactly how Elon Musk is orchestrating a $1.75 trillion retail bailout to intentionally bankrupt rival AI labs before this entire illusion collapses. Or you can just get the fuck out of here. Thank you guys for watching.